Look, I think there's three factors, and certainly the Fed backdrop is always part of that. And the idea that the Fed is carefully weighing the inflation picture with their policy, and I think it's been a little more dovish than some people in the market thought it would be. That's number one. Number two is earnings. The earnings have been very strong and supported another leg higher in equities. And then the third is the reopening trade as we continue to get better news around COVID. Obviously, the idea that now we have a pill that can help alleviate and potentially reduce deaths and hospitalizations further helps that reopening trade. So those three factors have really come together now.
In terms of the supply chain pressures that companies are reporting, what is your assumption as to when those supply chain pressures will peak? And how are you thinking about the pricing outlook and how sustainable these high margins are that corporates are reporting really across the board?
Well, look, I think that you just said it, right? Despite all the headlines around supply chain issues, the margins have remained strong, and we're not getting companies in aggregate taking down their estimates going forward. And so, we're going to continue to hear headlines of bottlenecks, but we're not seeing it come through really in earnings. And that's the most important thing for us as we invest capital.
So let's talk about investing capital. Give us a sense of your strategy at the moment from a regional perspective and a sector perspective, where you think the greatest opportunities are.
Absolutely. So we have been following the reopening trade, and now we're looking at Asia, specifically Japan, for a catch-up trade into the reopening. As more people are vaccinated there and things reopen. We also have recently put Europe as most preferred because Europe is a region where we actually see the economy improving slightly next year, and we still think there's catch-up trade. Now, in terms of sectors, we're going at it with energy and financials, where you could actually see a benefit if the inflation surprises to the upside. And then those are kind of our near-term trades. And then, of course, our clients have been early and really led us to try and be leaders ourselves on things like net zero and green tech and sustainable development. And we see that as one of the most important longer-term trends for public and private equity markets going forward.
So much to get into there. I want to just pick you up on your banking sector call within Europe last week. In the wake of the Bank of England surprise decision to keep rates on hold, we saw a pretty meaningful repricing lower of the UK banks. Is your call a long-term one when it comes to the European financial sector? How are you expecting things to play out near-term, given it feels as though we're in a little bit more of a dovish zone than investors had been anticipating?
Right. Well, look, some of the things out of the Bank of England surprised around UK rates, and that had an effect, as you said, on UK financials. But really, what has been the driver and will be the driver is how rates reprice off what's going on with the US 10-year Treasury. And there we think that there is some capacity for things to move higher. So there's rates. Then the second thing is banks obviously do better through economic recovery. So that helps. And then third, if inflation picks up and you do get a steeper yield curve, that will also benefit the financials. So there's several ways for that to work out going into next year.